Thanks for joining us for the Executive Series. Today I'm talking to Vince Pezzullo, who is Portfolio Manager at Perpetual. Vince, it's great to talk to you.
Hi Tom, good to be back.
Now, obviously, front of mind for most people at the moment are the themes that have emerged out of the reporting season. It's been a pretty mixed bag. What has been the lens that you've used to look at it?
So if we step back a few months and look at post-Brexit, there's obviously a lot of volatility, concerns and panic. Markets actually rallied pretty strongly into reporting season as that lower for longer theme kept popping through. You had healthcare, infrastructure, REITs performing really well into reporting season. But if you look at actually reporting season, what actually occurred, you had those sort of stocks, the CSLs disappointed, the high PE names, a lot of expectations built into it. The Telstras, the yielding stocks, they increased their capex by $3 billion. It shocked the market, so it's a risk to future dividends there. Property stocks were okay, but they started rolling off. But what you had was the things that performed well were the Woolworths, which had very low expectations. And for the first time ever, they printed their first like-for-like positive sales growth. Computershare, again, very low expectations going to reporting season. But they've shown a real turn in their business. And News Corp, again, one of the most underheld stocks in the market, showing very good momentum in their global real estate business. So it's actually been a very different reporting season to the last few. You've had the thematic of yield chasing was actually put to the side for the first time for a long time, and people focus on the actual results, and those with very high expectations actually disappointed consistently.
So it's really the overcrowding in particular popular names that's really becoming a liability for them.
At this moment, you want to be, at this point I think, you want to be looking, doing more stock selection, stock picking rather than thinking about overarching themes of what the Fed's going to do or what the Reserve Bank's going to do in Australia.
Okay, well, on that theme of stock picking, what's the biggest holding that you have in your portfolio?
So at the moment in the listed investment company, the largest holding is Woolworths. Again, we started accumulating a position late last year, building most of it through the first half of this year. Back on the basis of the management making some pretty big changes to the business. And through this period, they've actually executed on their strategy, which was close Masters, which was a very large cash burning business for them. Sell off the assets, the property portfolio. That was only announced 2 weeks ago. But more importantly, they've invested a lot back into their price, so becoming more price competitive than they ever have been. And that's actually shown with higher traffic numbers through their stores. So the consumers are definitely reacting. We're still to see it translating to bigger baskets at the moment, but they've, as I said before, they've generated the first like-for-like sales growth in basically 2 years. So we quite like Woolworths still. It's a very large position. We think it's materially undervalued. It's got very high quality assets, which we think the market's not paying up for yet.
And do you regard that as being quite a defensive holding or just opportunistic?
If you look at history, typically these food retailers are very defensive, but actually Woolworths has not been defensive. It's actually underperformed. It's underperformed in falling markets. But we think that's actually broken. That nexus is now broken because the market's now realising what the management's doing is starting to change the momentum of the business, underlying momentum of the business. And we think that now, if markets get a bit wobbly, people might start to buy back into Woolworths because they can see the momentum turning in the actual operations of the business.
Now, let's talk about the mandate that you have for the LIC, because you're able to have global reach there. Are there any things that are really allowing you to leverage that?
Yeah, so one of the themes in Australia at the moment is healthcare is very expensive, as in the stock market valuation of healthcare, not just the actual product or service. So we've been looking globally for some mid-caps, some healthcare mid-caps, and we found one in North America called Icon. It's actually an Irish business which is listed in North America. And what they are, they're a clinical research organisation. So their core franchise is large pharma and biopharma are outsourcing their clinical trials to these businesses to run for them, all the way from preclinical to phase 4 and economic trials. And these sort of companies trade at half the market multiple in Australia. So when we purchased our stake in Icon, we bought about 13 times PE. It's growing its earnings by about 8% a year. And if I always think of it this way, if that was listed in Australia, what would it trade on? It would probably trade on double the multiple. It's a very high quality business. Now it's a mid-cap type of company. That's sort of like the focus of the LIC, listed investment company, we are looking for these global mid-caps because you can find a lot of mispricing in that part of the market, and Icon is a perfect example of that. US healthcare has actually underperformed globally, the rest of the market, and we'd use that underperformance to build a pretty sizable position, and it's about the third largest holding in the league.
Wow, so that's really leveraging a number of factors, not least of which is the ageing population, the need for insurance companies to really optimise when it comes to the sort of policies that they put together for their holders.
Absolutely. So what you've seen last year was the FDA has approved the most drugs it's ever done in its history in 1 year. And what's going along with that is the payers, the insurance companies and the HMOs, managed health companies, they want an economic analysis of the benefit of the drug now. And that's what these sort of companies can provide. They are large collectors of data of the trial, and they basically analyse the data for the largest drug company to submit to the FDA. But then post-approval, now they are collecting more data once it's actually being used and prescribed to see if there's actually an economic benefit. It is actually doing what it says it does on the label. And what that's allowed is for the FDA to approve more orphan drugs, more of the smaller market drugs where morbidity is very high and mortality is very high, just to provide an offering to those people that are suffering under that. And this basically called economic trial allows the FDA and the payers to manage that and watch if it's actually doing what they say they do.
Vince, it's always good to talk to you. Thanks for your time.
Thanks, Tom.
And thanks for joining us for the Executive Series.